Hi, it's Marty from the Accelerator team and welcome to this week's episode of Business Stuff. This week we've got something slightly different for you. We asked our listeners or our viewers last week to submit questions that we would answer, and that's what we're going to do this week, Jack.
We are, yeah, I'm looking forward to it.
So we've had some good questions in. We did get the questions in advance, but we haven't put much prior thought in. We thought we'd just give you our honest, off-the-cuff opinions.
Yep, off the top of our heads.
So without any further ado, here's the first question. So Andre at Gosforth Homes asks, across the wide range of clients you have in different business sectors, what would your outlook on the secret to success and growth be? So I think what he's asking there is, what if you want to be successful, what's the secret?
Yeah, I mean, it's trying to boil it down to some very key objectives there, I suppose, across different sectors and stuff. I suppose the first thing is, obviously, you've got to have a plan. Planning ahead, that's the secret to success, really. It's not, things don't happen by accident or don't consistently happen correctly by accident, so it's always thinking ahead.
Anyone can get lucky, but harder workers are lucky more often, aren't they?
Yeah, definitely.
Yeah, and people who plan are more lucky again, aren't they?
Mm-hmm. So it's always having that kind of clear vision of, where you want the business to go. Ultimately, is if we're trying to keep it as broad brushed or broad stroked as possible. Because without getting into too sector specific stuff,
I mean, something I've seen over many years of dealing with clients that not that this is a business goal, but the people who work harder are definitely the people who are more focused, which is the plan, and work harder. So put all of their time into that plan. They are always the people that are more successful, I think.
Yeah. I mean, do you think enjoyment also falls into that as well? You got to like what you do or love what you do.
Well, yeah. People like Gary Vee say, find something you really like, and then put all of your time into it and find a way to make a business from it. I definitely see a correlation with people who enjoy what they do and their success. But I've still got some successful clients who hate what they do, but it works, so they don't feel like they can change what they do because it is working.
Yeah.
But I think you should have a plan and work non-stop towards the plan. I think people often get sidetracked and distracted into shiny things rather than the plan that was working and working the plan.
Yeah, and I suppose there's also times where people who just focus on the here and now can be very successful, but that's not to say that they could be more successful if they also had that vision as well.
Yeah. Because something might be working now, but could disappear at any time. We've seen that over the last 2 years. People had great businesses that disappeared, and they had no backup. They had no
contingency.
And when it happened, they weren't used to change. They weren't used to adapting to things. And so be open-minded. Have a plan, work at your plan.
It feels like this is
and hopefully enjoy it. They are the 4 secrets.
This sounds like the Monty Python Spanish Inquisition sketch at the moment.
The Ministry of Secret Business Growth. So I'm not sure we gave you an answer there, Andre, but hopefully you can pick something out of that. Our next question is Emma Walker from EW Estates, who asks, what net profit should a business be aiming for and why?
Well, I suppose kind of on the most fundamental level, it's actually, you basically need to make enough profit to cover what you want to take out of the business. We're always talking about clients, and it's not rocket science here, but we want you to grow your business, not just in terms of turnover, but that means over a sustained period of time, the value of your business per your balance sheet, your net assets, is growing. And that only happens by having a sustained net profit, which is greater than what you're drawing out of the business through dividends.
Just break that down then. So someone might have a turnover of 300 grand, they might spend 100 grand delivering the thing they did, they might have 100 grand's worth of overheads. The 100 that's left is their net profit.
Yes.
That needs to be at least the same or bigger than the amount you want to take out for your own personal use. Yeah. So if you want 300 grand a year, you need to make more money.
Yeah.
If you're happy on 50 grand a year, 100 is enough.
And you can take 50 grand out there and there's still £50,000 worth of retained earnings going through your balance sheet afterwards.
Yeah.
100
Okay.
minus 50.
Yeah. So in net profit then, I've just kind of alluded to it there, but let's say we've got a builder with 300 grand's worth of turnover. Because there's gross profit and net profit.
Yep.
And you're the accountant, I'm the tax idiot.
Well, I used to be an accountant.
So right, you're the classically trained accountant.
Okay.
So the builder would have 100 grand's, let's say 300 grand in, 100 grand's worth of cement, subbies, physically building stuff. Is that's their cost of sales.
Yep.
You take that off your turnover to get your gross profit.
Yes.
Your net profit, however, is after you then take off all of your general overheads. So if you've got an office, you might have an admin team, you might run a couple of vans, your insurances, your accountancy bills, you know, wages that aren't out building things, you know, so like I say, your admin, your marketing, etc. They all come out of your overhead, and your 100 grand left is your net profit.
Yes.
Yeah? So just in case Emma was asking about percentages then, is there a percentage? I think I know the answer, but
Yeah, well, it's difficult because, you know, there's different industries where you're going to have different percentages just through the nature of the business that you do. I mean, if you're a one-man band consultancy trader, then you're going to have a higher percentage of net profit because there's very little that you have in overheads. But if we're looking at like a supermarket, which has got hundreds or thousands of chain stores across the country, they're working on a much lower margin, but they're getting their profit through not just having a high margin, but just having a high amount of turnover of product.
Sell a million things and make a penny on each.
Yeah.
It adds up. Yeah.
And then you have on the other side, the consultant.
On the other side, you've got a person who's a consultant and their only cost is a mobile phone and their phone bill. Well, they've got no costs, so they've got a 99% net profit, haven't they? So, so chasing a net profit without reflection of the sector you're in is folly, to use an old word. So the best you can hope to do is benchmark and then try and be more profitable as a percentage than your competitors, I suppose. That's the best you can aim for here, isn't it?
If we go back to the old adage, I mean, profit is sanity. It's a sense check. I'm actually making a profit on, so the stuff, the amount I'm billing out is more than the stuff that I'm paying out to all of my different suppliers. It's a sense check, and ultimately it's that should give you some indication that hopefully I'm getting some cash in the business as well, but it's not guaranteed. There are different factors at play. So
yeah, because you have a profit per your accounts, but if nobody's paid you, you've still got an accounting profit but no cash. So there's still a lot of basics at play here. But
so it's thinking about net profit as, you know, one of your several kind of metrics that you're looking at.
Yeah. Okay then. Our next question is an anonymous question, for good reason when you hear it. When should you start planning your exit strategy?
Well, the answer to that is generally day one, isn't it? The day that you set your business up. It should be a kind of clear idea in your head, like, well, what is the end goal here? What do I want to do here? And I mean, that's all great in principle.
So nobody does that though, do
of course they don't.
Very few people do that.
Unless you're the one who's developing a time machine and you want to go back in time and redo that.
And nudge yourself and say, start now.
I mean, the second best option is today, right now, is thinking about, well, what does the end game look like here? What are my different options? Are all these options actually feasible? If not, and then it's kind of trying to pick a preferred path and then really kind of up in the ante. Yeah.
And in your exit strategy, there's not a presumption here, but most people think, well, that means to sell my business.
Yeah.
So let's cover that first. I suppose it depends who you want to sell to.
Mm-hmm.
If you want to sell to the market, if you want an external third party to come and buy you out, then you have to achieve certain things before that can happen. And the primary one is the business needs to be able to run without you being involved in it, doesn't it?
Yeah, we talk about being ready for sale, and that's generally the first thing. Like, you need to prove, sort of almost conversely, that you're not important to the business and it can run without you.
Which is quite a hard thing if you've spent many years building a business around you.
Yeah.
You need it then to like almost fly the nest and run without you before you can sell it, don't you?
Mm-hmm.
It's too late to wait until you've got a buyer to then go, honestly, it'll be fine, I'll be able to extract myself. You need to have proved that you can do that for maximum value, don't you?
Yeah, and we've talked in previous episodes about the entrepreneurial model, which is what generally a lot of businesses are, where it's just the owner and he kind of runs the show. But in order to be truly saleable, it's kind of shown that you've developed those systems, that you actually have people that you delegate stuff to, they're competent, they know what they're doing, and therefore you can just let them run and just enjoy yourself a little bit.
Yeah. So the perfect business to sell is the one where the managing director pops in half an afternoon a week just to basically make sure everything's all right.
Yeah, open the post and all that.
It will be much easier for them to sell than it will if you're running a restaurant and you're, you know, frying the steaks, taking the orders, packing the boxes and delivering, and, you know, and sitting people at tables. It's going to be quite a hard thing to sell, isn't it?
Yeah.
If you're selling internally though, Jack, because you might say, well, I can't take myself out entirely, but I've got a solid management team who know what I do, and they could replace me. That's a different proposal. A management buyout is a different thing, isn't it?
Yeah, it's less aggressive, and it can be phased out more effectively. I mean, there are circumstances where external sales, where you are still involved for a certain period of time, but this can be a lot better managed, in the sense that, yeah, it can be gradual. I mean, the actual release of equity can be done over a kind of longer period of time, just so everyone's happy with how things are progressing.
And you could just phase down your involvement rather than withdraw your involvement, couldn't you?
Yeah, absolutely. So,
and often if you've got a management team willing to step up to take on the responsibilities that the owner did have, it might be easier to replace their duties across the rest of the team than it is to replace yours, you know, without having people to step into them.
mm-hmm.
Yeah. There's also a realization here as well that a lot of businesses don't actually have any value.
Yeah.
So planning for exit, well, if you're just going to close the doors, then I suppose you do it when you've got enough money to retire, don't you?
Yeah, and again, this just because that's the most simple of options doesn't mean it doesn't involve some kind of planning, because ultimately it ties in with your wider personal goals, where you've worked out, well, how much money do I actually need as a result of closing down this business? What is the lump sum that I need at the end of the day in order for me to continue the lifestyle that I want to do? And it's nothing. I can imagine it'd be nothing worse than actually closing the doors, getting a big lump sum, thinking that's enough, and then actually 10 years down the line, you're like, oh, I'm actually out of cash. Yeah. So it's a period of kind of setting that time period of, well, how long do I need to keep trading in order to get that lump sum?
Yeah.
And what are the tax implications of closing it down?
Well, I know our financial planning team as well. A lot of what they do, a lot of financial planners basically sell products. Mm-hmm. Our financial planning team spend a long time actually working to plot a lifetime cash flow, so that when you get that lump, ideally you get the lump, whether it's through sale or a pension lump sum on initial retirement, you can plot out how much you need and for how long. And you can actually use that to then model when you should or should not retire. Mm-hmm. And it's quite funny, because speaking with the team over many years, they'll say people come in and go, well, I'm ready to retire, and they're not. They're woefully ill prepared for 30 years of retirement.
Yeah.
But just as often they get people who come in and say, well, you know, I wish I could retire. And when you look at it, they easily could. Their business is already worth twice what they need to have a comfortable 30 years retirement.
Yeah.
So yeah, you know, maybe a start is to, you know, we as an accelerator team can help you work out how to extract yourself from the business. That might be something that's worth doing initially. But also, it's probably worth us penciling in an episode with the financial planning team, so they can talk about how you go through this lifetime cash flow.
James, the producer's nodding, so
yeah,
I think
the
got the next episode sorted.
The producer has made a note. The next question is an interesting one. It's from the same person, so I don't know if they're thinking, well, I might not exit. I might just spend all of my money at the races. But they're saying also, is corporate entertaining a thing of the past? You know, would you take your clients to the races or for a meal, or is this kind of bigger spend, or, you know, all day entertaining on the wane? From my own experience, I had one year where I was invited to the Cannes Film Festival, Oktoberfest, and skiing somewhere. I can't remember where. All in 1 year. I only did one of them. But yeah, I mean, it's been a long time since I had any invites remotely like that. I mean, this was probably 14, 15 years ago now, and yeah, probably the best I've had, not that I'm complaining, is, you know, do you want to come to a charity ball, but bring plenty of money because you're buying raffle tickets.
Yeah.
So this idea of the big thing does seem to have gone.
Well, I've been here 8 years or almost 9 years now, and I've never been on such extravagances as you've described. So I tend to agree with you on that. And certainly the days of you know, customer and supplier entertainment are probably long gone, and yeah, for good reason, because there's the idea of it is that it's not actually a tax efficient or tax benefit in order to do it anymore. Yeah. Well, it never was really, I suppose.
Well, yeah, it's worth covering this off very quickly. So a lot of people, I mean, I played golf with a lad years ago, and he I said, I didn't know you were even a golfer. And he went, I'm not really, but you know, if the tax man's paying for it, why would I not play golf? Mm-hmm. And I kind of said, well, you realise the tax man doesn't pay for this. You've paid for it, and it comes out of your business pot. Mm-hmm. He's like, yeah, but at least I save tax. I was like, but you don't. And he was shocked that not only did he not save any tax, but he actually thought pound for pound it came off his tax bill, which was, I think, where he got that from. Mm-hmm. Probably from the person at the golf course who sold him this
membership,
this season pass of 24 balls that he bought. Mm-hmm. So he was a bit alarmed at that. So yeah, just for clarity, you don't get tax relief, and you can't recover the VAT on entertaining. Mm-hmm. There are some types of staff entertaining where you can, but it's quite limited. Again, you can't take you can't just go to Tenerife, for a fortnight, twice a year and take a team, which is why we don't do it, Jack.
Is that the only reason?
Because you can't do that. It's not something that you can just do, which I think is often misunderstood.
Yeah.
So why would you do this? It's a marketing spend, and it has to have a payback. Mm-hmm. It's that's it. So you might just say, well, we'll do certain things, we'll get people along, because people need to know who we are, and it's a way to try and attract custom to the business. Mm-hmm. If it is, great, but it's not a tax write-off. It's just a cost.
Yeah.
Or you might, or you just need to accept that. Well, we're doing it for brand awareness. Not, I might entertain you because I want to get your business, or I might just say, well, you're in the kind of sector where people need to know who we are. Apart from that, there isn't any other reason to do it. Mm-hmm. Or I might say, thank you for your business. You've got to be careful now because you've got the Bribery Act and things like that. So, depending on the sector.
We've certainly covered a lot of ground there, haven't we?
Well, it's just they're kind of saying it in jest, but, if you get a lot of work off local authorities, for instance, or government bodies, they can't actually accept entertaining. So it's quite hard to say, well, we'll take 6, council officials off to the races. Mm-hmm. They can't really do that kind of stuff now because they've got to report it and say why they went, and they tend to then just say, we can't, sorry, it's not worth it. Yeah. So we asked a couple of people, we get a lot of work from Newcastle Council to a World Cup event we did probably about, I don't know, it must be 10, 12 years ago, whatever it was, or 13 or whatever, I can't work out the maths. And they kind of went, well, we'd love to come, but we can't. So we had to get around this. They had a stall at the World Cup event because then they were at an exhibition rather than being entertained.
I don't know if you've just exposed a giant loophole in a potential scandal in the council.
Well, I'm not sure it was there. We literally bought them a couple of pints and they had a couple of chicken wings, so we didn't exactly take them to Tenerife for the week. Anyway, there you go. So I hope that's cleared some stuff up.
I just wanted to add one last thing. Presumably the guy that actually took you to play golf, you then billed him for that advice, did he?
Well, of course I did. Okay, yeah,
insult to injury for him there.
Absolutely, I then billed him £200 for the tax advice because we played. It was like 4 hours of my time. He wasn't getting that for free. So Shervin has asked, can my limited company, which invests in rental income properties, also invest in digital assets? Which I presume is a crypto question.
A cryptic crypto question.
A cryptic
question.
Yeah.
I'll say that 10 times quickly.
Yeah, I barely said it once, Jack. I'm not going to say it again. I mean, I'll cover off a couple of tax things here. Yes is the simple answer. There is nothing stopping companies from doing almost anything they want as long as it's legal. There are good reasons why you may or may not do any activity though in a company versus personal. And for crypto in particular, it's the sale at profit is normally a capital gain. Capital gains are generally taxed more efficiently on individuals than they are on companies. But apart from that, it's like, well, yeah, you can. But I suppose we should also talk about whether you should mix what could be perceived as a risky activity with non-risky activities. Is there is there like a separation, kind of like eggs in a basket type point there, Jack?
Yeah, well, it's if we're talking about using a limited company in any sense, it has the limited liability, which is obviously good. It limits you to only the shareholders to the amount that they've invested, essentially.
Yeah. So you can't lose your personal assets generally in a limited company.
But yeah, you've hit the nail on the head there in terms of having two separate trades in there. They still fall within that same limited liability. So if something goes wrong with your digital assets, suddenly you might have to start selling some rental properties in order to cover some of these losses. Yeah. So the idea
or vice versa. Interest rates could quadruple in the next 5 years. You're now losing the keys on your rental properties. If your crypto is doing well, that's in the pot, isn't it?
Yeah.
It's lost in the same way, isn't it? Yeah.
Yeah.
And one of the reasons I think if people ask this kind of question is because they might want to do this activity personally, but the money is locked up in the company. And there's, of course, tax implications on getting the money out of the company. So you might lose a third of it getting it out, which means you can't buy as much of the thing you wanted to do. But it's worth bearing in mind that there might be a good reason why accepting that tax loss to get it out is actually worth doing. But the short answer is yes, you can. But a bit like the exit strategy question, when should you get advice on that? It's before you do it. Next question then. So Charlie Sullivan at Capstone Fox, hi Charlie, has asked, what's the biggest mistake you see business owners make when it comes to financial management within their business? We were always going to mention it, Jack. What are we going to mention?
Cash
flow. Make sure you keep an eye on your cash.
We always say it, don't we?
Yeah, it comes in. So thanks, Charlie, for that.
But actually, conversely, another kind of bad habit I see from business owners is that they only look at their cash as a snapshot, and that is the one kind of way that they measure their business.
Yeah. Like, how much money's in the bank?
Yeah.
I must be all right.
Yeah. But if you're not looking at even kind of extrapolating that out to your working capital, so how much do people owe you? How much do you need to pay out? Like, it's all well and good having 20 grand in the bank, but you're still chasing up 10 grand and you've got to pay 40 out. Like, suddenly, actually, that 20 grand's not actually the business is not as rosy as you're actually expecting it to be.
Classic one's tax. So a lot of companies have a March year end. They get the run up to Christmas, think we've done really well here. We've got a bit of money in the bank. We'll have a couple of Christmas bonuses out, and they forget that the corporation tax due on the 1st of January, and they might have a December VAT quarter and a massive VAT bill to come out early February as well, and they think, I didn't think about that when I thought I had some money, because they weren't looking that just a little bit ahead even.
But even if they pay out a bonus or a dividend, there's a small chance they might be able to put that back into the business, but if they're deciding to spend it on something slightly less liquid, like a car or a
they might decide to buy a van instead of lease a van.
Yeah.
So well, you might wish that you hadn't because the money's gone now.
Yeah.
You can't remortgage a van. It's, you can't say, can't go back to Benfield commercial and go, can I give you this back and actually just
can I have my 40 grand
back, have some of my money back, please? Yeah. So you've got to be really careful. So, but yeah, because most businesses can, if you monitor your cash wisely, no business will ever fail. It might not be worth your time, it might not be a profitable business, but if you manage your cash wisely, you will never fail. But equally, you need to have an element of risk if you want the big reward, don't you? You can't run it too cash rich because you're clearly not taking enough risk then. So there is such a thing as too much cash in a business, isn't there? Because it's not working for you, it's just sitting idle. If it's not working for you, it's
especially
idle.
when the actual what are the benefits of having lots of cash in the business? Well, if you're not getting any revenue out of it,
it's just security. But if you're not making any money either, if you just got a cash pile there getting diminished by inflation, what's the point?
Yeah, and and then it's even the case of then like, well, are you even extracting some of this money out? Is that your strategy? But presumably, if you're in that business, you're wanting to grow it. So yeah, it's about kind of measuring up that risk at the end of the day. So I mean, I suppose the answer to this then is ultimately it's not just looking at your cash as a set point in time. It's about measuring all of the different potential areas of the business. You know, profit is very important. Turnover is very important. Cash flow obviously incredibly important. And thinking about it, as working capital rather than just my cash balance as of today is fine.
Yeah. And we'll move on to the next question if that's okay.
Yeah, I think that was a very definitive answer.
James, can you just make a note of the time though? Jack, when you move, there's like and I'm conscious that might be coming across on the...
It's this dodgy chair.
That stopped anyway.
Fixed it now.
Sorry, is that okay, James?
Yeah, it's cool.
On here it's 22 minutes, 24 seconds if you want that time. Although they'll be synced, won't they? Yeah. And Charlie's also asked the second question. How can business owners maximise value from their accountant?
Well, I suppose one of the key things is just keeping in regular contact with us, where we can provide the best possible advice when we're in the loop about things, and that requires regular catch-ups. There's nothing more frustrating for an accountant, and obviously for their clients as well, is when they, after the fact, they say they've done something and you go, "Oh, you're joking. Why have you done that?
Why did you do it like that?"
Yeah.
Or
What if you've done it this way? And then at this point they're kind of going, "Oh well, can we do something about it?" And you go, "Well, no, it's too late now.
Yeah.
We're doing the year-end meeting. You know, we've prepared the accounts.
Yeah.
The year-end was 4 months ago. Like, I'm sorry."
Yeah.
And then everyone comes out of that frustrated because they're like, "Well, I haven't got value out of my account."
Because we wish we could have done more.
Yeah.
We wish we could have helped.
Yeah.
And they wish we could have done more.
Exactly.
And it's like, well, actually, if we just spoke at the time, yeah.
Yeah, so that constant communication and keeping people in the loop, like we can only provide the best possible advice to you if we know everything. And I'm not passing all the blame on to our clients to say you have to ring us about stuff, but you know, we need to be proactive as well, and we're trying to do that. Certainly Robson Laidlaw are trying to do that and pick up the phone and be a bit more proactive.
Yeah.
And for every time that works, it's a great feeling. Like when you've caught something ahead of time, you know, even if it's like a pension contribution and they're like, "Oh, I've got a bit of cash in the bank. Oh, the year end's actually in a couple of weeks." Well, you've got your SIP set up. Let's put some money in there. Let's make some corporation tax savings. Let's boost up your pension, and that's like brilliant. And something small as that, you know, adds so much value to everyone.
Yeah. I think you touched on something there as well, Jack. Is and it doesn't matter whether you're an accountant or anyone who gives any advice on stuff. There's nothing more frustrating than advice that isn't followed, which isn't the end of the world. You might say, well, what about this? And it's not for the client, which is fine. But it's very annoying then to then have a client who comes back to you and says, well, this is a disaster. And you go, yeah, but we did tell you about this. Because again, that just sours the relationship. So, and again, it comes back to communication. You just need to make sure that you're on the same page.
Yeah.
We need to know what the business is planning, what they're trying to achieve, why they're trying to achieve it, all the things we talk about in our accelerator team meetings. Does the thing you're doing get you closer to your plan? We can only help make sure you're doing things that are helping you get to your plan if we know what your plan is. And we've got a couple of clients who actually who drop us in on their internal, you know, like quarterly summary of what they've been up to. And it's not their figures necessarily. It's, you know, this happened and it was good. You know, we were planning this and it went well, and we're going to, you know, take stock of this and do something else. And it's great because it takes us a couple of minutes to skim through and go, right, well, we know what they're up to. But it helps you catch things when you then have the year-end meeting. You go, but why did you do that? That isn't what you said. Yeah, you're right, Marty. Thanks for reminding me. Why did we do that? You know. So it's definitely better when you've got proper communication.
Yeah, there's a definite correlation between the the performance of our clients and how often we keep in touch with them, and the correlation of the advice they get. I mean, the best example I can give is the R&D stuff, which we set up a few years ago. And to start off with, the conversations we were having with clients were, well, why didn't you tell us about this before? And at that point, it's like, yeah, I put my hands up. We weren't providing this. We dropped the ball maybe on a few of our clients.
Well, we simply didn't provide. It's
provide
a specialist service, which at the time we didn't do. So,
but now it's more of a when we're onboarding new clients, it's part of our kind of onboarding procedure. Have you thought about R&D? And it's like, no, we haven't. That's brilliant, fantastic, and that's an immediate win because they're like, oh, you've saved us a bit of tax. That's fantastic. But
I think also as well, I think there's there's a lot of jokes about accountants and solicitors. It's like moral dilemma. You've got an elderly, frail lady in your room, and when she leaves, you realise she's left her purse on the floor. Moral dilemma: do you keep the money or do you share it with your business partners? And like that's the joke. And I think a lot of people think, well, the professional services are just out to try and just bill you as much as they can all the time for no reason. And I think often people forget that we're just trying to help. We charge only because we're not a charity. We don't do stuff just so we can charge. We only charge for helping. We're providing a service here, So we never just sit and think, well, I wonder who I can bill today for something that they don't want and don't value.
Yeah.
So try. I suppose. And again, that's not just accountants. It could be any business, but just always remember, if you've asked for something, there'll always be a cost, and we'll only charge you what it's reasonably took to do the work.
Yeah, the value of it is important, and it's harder to justify in compliance because there isn't that kind of obvious value that you can see from it, and it's a lot easier from a tax advisory and hopefully on a business advisory point of view where you can actually show something tangible.
Yeah, it's quite frustrating if it costs you a couple of grand to get a set of accounts when you didn't even want them. You just had to send them in.
Because I have to. God.
That's quite annoying.
Yeah.
But all of these things, actually, I think the single thing here is just trust. You should have an accountant who you trust has your back, who you know that all they're trying to do is help you, and will only charge you for the work they've genuinely done. And if you've got that open communication in a trusting kind of relationship with your advisor, then everyone benefits.
Yeah.
You've got an accountant who's happy to work for you because they know you're happy with what they're doing.
Yeah.
And you should see the value in what they're doing because you've got this open, clear communication lines, So trust, I think, is the way. And if you don't think you've got that, then you shouldn't be with that person.
Yeah.
If you were building houses for a living and you had a project manager who you thought, pretty sure he's stealing half the bricks off everything, if you didn't trust the person, you wouldn't keep working with them, would you? So,
no.
If you don't trust someone who should be your most trusted advisor, which is what your accountant should be, other than, say, a doctor, we should be the most trusted person who you seek advice from.
Yeah.
And if we're not, then yeah, you shouldn't be with that advisor, I would say. Which might seem like a weird way to answer. We're not saying goodbye. And Charlie, we speak to Charlie a lot. He's great. He lets us know exactly what he's doing.
Covering that off.
So yeah, so hopefully, Charlie, that rang true with what you get from us. We've got two more questions. Brian Lawmore has asked, what are your predictions for interest rates rising and inflation? How will it affect people on fixed rate mortgages that are coming to an end? I suppose we should open with, we are not mortgage advisors. We're very happy to give you an introduction to a solid mortgage advisor if that's what you want. But what do you reckon then, Jack? Where are we going here?
Well, I mean, I think we've already seen an indication. Interest rates have already gone up again, announced last week. So that's obviously a clear indication that at least the Bank of England is seeing that it's necessary to increase these interest rates in order to curtail inflation at the moment, because that seems to be creeping up more and more to a kind of a alarming rate. Yeah. And speaking as someone who's on a fixed rate mortgage at the moment and has another couple of years left on it, it's it is worrying a little bit. But
it'll all wash out in a couple of years, Jack. Yeah. If you think rates are high now, just wait till you see them in a couple of years.
Yeah.
I'm teasing. I'm old enough to remember interest rates significantly higher than now, but also kind of the generation before me was paying, 15, 16, 18, 20% on their borrowing, which was mind blowing to me. My first mortgage was something like 6.5%, 7%, I think, which again seems mind blowing to now.
Yeah.
I think we're used to artificially low rates, and it's, as much as it pains me as someone with a lot of mortgages, I think rates probably do need to go up 3 or 4%. If for no other reason, it gives an exhaust method for the Bank of England if the economy starts to run away. I think they've almost had to put rates up now to try and curb the inflation. But if inflation was to gallop away, that they can only go so high. But then perversely, if we had a period of really low inflation because the economy was awash with cash, there isn't much they can do, and I'm kind of mixing my ways there. But if we get in a position where they need to reduce interest rates, they kind of can't at the minute. Because they're already as low as they can.
And let's not forget when the reason they went down to start off with and how long ago that actually was.
Oh yeah, it's been like 13, 14 years of record low interest rates. So it has to go up. Interestingly, and I could get the numbers wrong on this, but a mortgage broker bought me lunch the other day talking about massive marketing spends. It was his turn, to be fair. And I'm pretty sure he said something like 70% of people with mortgages are on fixed rates anyway. So I think, and I don't want to misquote him, but he made the point that, you read the front of the red tops and it'll say, energy crisis, which there is, and then the Bank of England, oblivious to the poor working man. 70% of the working man isn't getting an increase.
Yeah.
And there's actually a significant proportion of the society that doesn't have a mortgage anyway. So the interest rate increase doesn't affect as many people as you might think. I think inflation will affect more people.
Yeah, so it's a trade-off, which is the basics of economics, basically.
Yeah, so I think there might be, I'm far from an economist, and if I was, I would be used to being wrong all of the time because it's practically impossible to be right much. Yeah. But I think it's probably more of a signal to people not to keep borrowing at the rates they are, and it's probably meant more as like a nudge tactic necessarily than a direct lever to take money out of the economy. I just that's the impression I got from the mortgage broker I was speaking to anyway.
Yeah, I suppose the important question is, did you go with the wine pairing with the taster menu that he bought you?
We didn't have any wine. It was a working lunch, Jack, so I had a mocktail.
Well, surely recent events at Downing Street mean that alcohol's compulsory yet.
Well, it wasn't a work event then because no, we didn't. There was no cheese or wine involved, so it wasn't a work event.
We almost got through the whole episode without mentioning it.
Yeah. Well, as you did economics and politics at university, didn't you? And then this was the perfect question to try and shoehorn that in. Well done, Jack. We've got one final question here, and it's from Dave. And Dave asks, should I get an electric company car? What should Dave do?
Dave, if he's looking at getting a company car anyway, the electric one's clearly the best way forward. It's the most tax beneficial in terms of, I don't want to get too technical, but you're more likely to recover the cost of the car quicker through your corporation tax
against
return.
Profits. It's
so you get 100% of that value offset in the first year, which is great.
Off your profits, not your tax.
Yes, off your profits.
Just,
so
in,
it's not a
just in
pound
case
for
my
pound.
Galton pal is thinking, a tax man's buying me a car. He's not buying you a car.
Unfortunately not.
You'll pay. But you will save more tax on an electric car sooner than any other kind of car.
Yeah, absolutely. And then in terms of the personal benefit to you, it's a lot more beneficial compared to getting a petrol or even diesel kind of counterpart.
Yeah, because I'll use bigger numbers just to illustrate the point. But a 50 grand Land Rover diesel or Range Rover diesel with private fuel provided will cost you a fair amount in personal tax through your pay slip, because the perk is taxed far greater on diesel and petrol vehicles.
Yeah, it's a percentage.
But a 50 grand Tesla would cost buttons by comparison. Yeah.
And no fuel benefit as well.
And there's no fuel benefit, yeah. So you know, it might cost a little bit more to get a comparable electric car, although I think the differentials are dropping and are all but nothing now. But yeah, if the key word there is anyway. If you're getting a company car anyway, then electric at the moment is certainly incentivised.
Definitely.
And I think what they've done here is, because in the tax world, there were tax incentives to get people to get electric cars, which kind of then got took away, and they're back in at the moment, probably as part of our, you know, kind of net zero goal as a country. Plus you've got the impending banning on the sale of new combustion engine vehicles from 2030, I think it is. But it's worth bearing in mind that where we will end up here is in 2030, if not before, you probably will just have normal taxation on electric cars, because at some point they won't need to encourage people to get electric cars
they have to get them.
Yeah. So this tax benefit on electric cars is a form of kind of social nudging or social engineering. It's incentivizing a behaviour that they want to happen. It's worth remembering that once it is happening as normal business, they won't need to incentivize it anymore. So, you know, 10 years from now, an electric car, a Tesla company car, will be just as heavily penalised through a company car as a diesel is now, because it will then just be the normal perk. If there's now hydrogen cars in 10 years, it will be the hydrogen one that gets the perk. So it's interesting. You've got to remember that.
Yeah.
Tax is often used as a social nudge to encourage a type of behaviour, but only when it needs to be encouraged.
Definitely, yeah.
So I think, I can't remember the stats now, but it was 20-30% of all new registrations in the last year were something like electric or hybrid. It's a fairly large amount. Once that hits 70-80%, they won't need to encourage it anymore. Yeah. So this is probably a one-off, 3-year window to lease that Tesla. But don't just assume that it'll be the right decision in 3 years.
Absolutely, yeah.
If that's how long a car, I don't know. My car's 14-year-old, so most people renew their cars more often.
Well, actually, probably within 3 years, you might actually get one that you've ordered, because there's quite a big backlog.
Well, that's the other thing. Yeah. Order now, but don't expect it anytime soon. We haven't got any other questions, but I hope that's been of use. It's actually been quite interesting not having to think of a topic to talk about for an episode, and I hope you, our listeners and viewers, have certainly got more from that. I would like to hope that's the case. If any of those questions that we've answered were submitted by you, thanks. If you didn't quite get the answer you were hoping, because we've just kind of, ordinarily there'd be follow-up questions to get to the heart of what the question's actually asking. Very happy to have a chat and expand a bit more. If you want to submit a question for another episode, please feel free to do that. Meanwhile, we look forward to seeing you on the next episode. Yeah. Anything to close on, Jack?
No, thanks very much. I've really enjoyed it. I've got to exercise some different muscles. Good. So I'm happy.
Whether you enjoyed it or not, Jack was happy, which is just as important. But joking aside, thank you very much, and see you next episode from Mauritius for me. But these two will be here.